Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we help you understand the closing action of the D Street and how the way the trade panned out throughout the trading session in terms of the benchmarks, the sectors and the stocks that have been moving the most in trade, and also what can you expect as we move forward from here too. We'll also be joined by an expert to break down things more clearly for us as to what should be the apt strategy that investors should adopt at this point in time. But to first check on the markets right here. It's been a great Monday so far. 830 points up for the Sensex, 60,728, 18,096 for the Nifty as well, 237 points uptick for that one. Although the markets have been hovering near this range of 1.3% uptick, 1.4% uptick right from the word go today, but there's been a substantial bounce from what we had seen as a dismal performance in the previous week as well. Of course, the global markets have been supporting, and that's why we've been seeing an all-across rally throughout the trade today. When you talk about the mid and the small caps, they are helping the markets move higher as well. In terms of the mid and small cap 100 indices, both are up by about, so the mid caps is up by about 0.8%, or the small caps have seen some kind of a sell-off from those high points of the day, about 0.5% uptick for that one too. The India VIX levels comfortable at around 14.7, down by 2% odd. In terms of the sectors, it's the IT space that has really hogged all the limelight today, about 3% uptick, almost at the day's high. The Nifty IT is going to be closing the day with the leading gains, when you compare it with the other sectors as well. The Nifty Bank moving higher too, over 1% uptick for that one, with all the contributing factors, financial services, private banks, PSU banks, all of them up by about 1% odd each. Apart from this, you have the metals that are shining bright, 1.3% uptick for that one too. The autos moving in the faster lane, 1.2% uptick for that one. FMCG, pharma showing slight bit of uptick as well, and the realty space also moving higher. So it's an all across buying action that you're seeing all across. 44 stocks in the green as against 6 declines on the Nifty 50. The top movers at this point in time: Mahindra & Mahindra, from the auto pack, 3.5% uptick. IndusInd Bank, TCS, Tech Mahindra, HCL Technologies, IT companies definitely moving right ahead of these earnings, which kickstart today with TCS coming out with the numbers first. Titan is sulking, 1.7% down. HDFC Life, Bajaj Auto, Britannia and Bajaj Finserv, the other laggards at this point in time, in an otherwise quite a buoyant market that we've been seeing. Let's now welcome our guest for the day. Mrinal Singh joins in. He is the CEO and CIO at InCred Asset Management. Welcome, Mr. Singh, and thank you so much for taking the time out for this discussion. Well, after that dismal performance or show on the street last week, today looks like a good day. Can it be the start of a pre-budget rally that everybody's been hoping for?
Well, there's no harm assuming that, but then the reality is, Sakshi, that the global cues have driven the market up today. Particularly, tech is reflecting the Friday closing of the Nasdaq, and Nasdaq responded to the better data points that came across from the US economy. So, well, we obviously are trying to, as fundamental investors, trying to look across the horizon, and we think that but for the geopolitical risk that exists in Europe in particular, and some slowdown risk that in US could play out, I think the Indian economy is well placed for growth driven by domestic demand and a combination of moderate demand from Europe and US combined.
Right, and we are at the beginning of this earnings season, Q3. How does the entire Q3 look to you? What kind of promising sectors are you looking at this point in time?
Very, very interesting question. So, almost 20 years plus of investing that I've done on the professional landscape. Generally, more often than not, I've seen the expectations when they are subdued. It's very likely that the companies might actually do a bit better. So it's not true all the time, but then at least we begin the earnings season with the tech and TCS in particular today evening. I think the street across the board has modest expectation from IT in particular, and the businesses can potentially do a little better, which could be good because it's a large weight in the index and it reflects well on the overall scheme of things. But the real propulsion of volume, I think the domestic demand oriented businesses would be key. We would like to watch for, in particular, the management commentary, both on the tech side as well as on the domestic demand side. The most important point or insight that I want to have a look from this result season is how the rural volumes and demand shape up. I think the calendar year 23 belongs to rural volume picking up. I think that could potentially be a very big uptick that we could see.
Okay, I noted that. Now let's come back to IT a little bit because that's where all the focus is today in terms of the stock market performance, and also because the earnings start to trickle in today with TCS, like you pointed out. So, what is your expectation with respect to the commentary coming in from TCS this time around? Do you expect them to talk about clients' budgets really being cut down, and if yes, do you see a further downside in the sector?
So if I go by historical trends, every time US has had slowdowns, the conversation with outsourcing vendors like the IT companies that we're talking about generally moves into a higher propulsion data. By that I mean larger ticket sizes, in what form and shape can cost can be cut out for the client. So we want to see is it going to be same? I would hazard a guess and say that very likely yes. We are seeing very large announcements of layoffs, particularly from US corporations,
Yeah.
but businesses are still growing, so they will have to make up for it in terms of more outsourcing contracts. So that could potentially increase volume for these businesses. I would like to hear what the managements in IT in particular talk about it. How do they see the margin outlook, particularly that would be very important, and which segment and vertical in particular is showing traction, because the entire IT landscape is about the verticals and the horizontals.
Hmm.
So how does digital come across? How does retail come across, or manufacturing, or a variety of other? So where is the space? Because various businesses have different revenue contribution from different verticals and horizontals.
Okay, would you also have any pecking order in which you're looking at these top four, top five names from the IT pack?
So that choice of investing actually becomes classical valuation game. We so and it's a function of how the profits could potentially look in some period of time. So as the space looks like, amongst the large caps, there is difficult and very little to distinguish, but we do have a pecking order, and that's largely to do with valuation. And most of these large IT names have pristine corporate governance now as they stand. Cash flow generations are very good. Quality of earnings is nice. So
Hmm.
it just becomes a function of which one can do better on the growth, and that's exactly what I meant when I talked. Which growth verticals or horizontals are showing demand traction, and that would determine which amongst these could potentially show better growth trajectory, and that would demand maybe a better premium or better valuation, and where is the gap. So I'm not getting specific into stocks,
Sure.
Sakshi. I know you want me to, but that's the whole idea behind
Sure.
choosing.
So, with respect to how mid cap versus large cap is expected to fare, do you believe that mid caps will continue to lead from the front when it comes to revenue growth, and really what happens to the valuations then also?
So very, very interesting. This IT space on mid and large is very different compared to other spaces. I would have used a blanket statement saying on the domestic oriented businesses, the mid caps can potentially outsmart the large caps given the size and a variety of other things. But on the IT space, actually, it is of a great advantage if you're a large outsourcing vendor. Clients are much more comfortable if you have a balance sheet capability to scale up. So we've seen for a prolonged period of time, the broader, larger IT names have outgrown the mid cap names over, let's say, last 5, 7 years or so. But then that's not to say that some select mid caps, which are niche, have some special skills that they bring on the table, cannot do well. Yes, they can. And obviously, there are quite a few that we can potentially choose from. But a blanket statement that mid caps will outperform the large caps would be difficult. I think a couple of large caps can potentially do better, and couple of mid caps can potentially surprise and have very long compounding growth on the revenue side. And that's more to do with niche skills and client concentrations and things like those.
Okay, so let's now move on from the IT space and talk more about the overall macros in Indian markets. What do you make of the global investors and how they are eyeing India at the moment? Because, we're just speaking of how the first week itself saw a lot of outflows from FIIs and FPIs, and this is on the back of the already weak numbers that we were seen in the last months of 2022. Is this the China versus India trade really playing out, that flows are moving away from India? What is your sense really here?
Oh, very, very interesting. I mean, if see, we can sit here and talk India versus China, but in reality, if it was happening in Shanghai, is where it would matter. The I don't think fundamental investors look at it that way. Relative investors definitely do. We see a large portion of FI monies that get deployed or the flows of FIs are largely to do with ETFs that emanate from that part of the world. So that's more to do with allocation coming to a gem fund, and India does get a share based on the percentage weight and all of that. But classical pension funds or long only investors or active investors look at it differently. I think India is at a premium to the region in the emerging world as well as Asia. But there is a good reason why it should be at premium, and there are interesting businesses which could potentially justify that premium. So I guess that's where they would like to focus, and we do see signs of that. But broadly, the flows have been quite erratic. Last 2 years in particular, the FIF flows have been kind of all over the place. I mean, we've thought that the valuations are interesting and they would active monies would come in, and we've seen all kinds of things. So I don't see, there was a time 10, 15 years ago when the FIs were a significant participant in the market. At least for the last 4, 5 years, the most significant participant in the market is retail itself. They
Yeah.
are the largest part of the cash market, followed by institutions, and within institutions, DIs actually for most days in a year are larger than FIs. So FIs do matter, yes, but then they are also like any other institution making their decisions, like we all in the domestic side
So
do.
do you expect the domestics to stand up again in 2023 if the FIs continue to, sell the way they have done in 2021 and in 2022, in fact? So do you really expect that? Because, they have acted as shock absorbers. Will they continue to do so?
Well, very tricky question, Sakshi. I mean, frankly, for it's the intermittent flows, the demand supply gap on a particular day could be X, Y, Z, but in reality, that's not what we as investors focus on. We really are much more bothered about where are the profits going. Finally, the stocks are going to not trace the flow, but trace the earnings. So the
Sure.
earnings are, if the earnings are going to, let's say, in 2, 3, 5 years, look substantially better and bigger, I think no matter what the flows is, FI, domestic, or maybe anything else, it should finally trace there. So that's what. So the flows of the day will create imbalances. The markets will overreact in either direction. We'll try to make the most of it by either withdrawing or, deploying monies, as the case may be.
Yeah, you also began talking about, how positive you are on the domestic economy related sectors as well. So, could you elaborate a little bit more on the way domestic economy related stocks or pockets like capital goods, banks, consumption related themes, and manufacturing are likely to play out? And, going forward from here, is there a trade that investors can definitely focus in this year?
So we are seeing exceptional data after a long period of time, particularly in areas like credit growth driven by the industry. It's a very good sign. We've seen almost more than 15 months of manufacturing export continuing to grow. We've also seen a big uptake in the capital goods order book of the domestic companies, as well as large import orders for capital goods, which clearly points us in the direction that there is capacity augmentation happening in the economy. The broader capacity utilization parameter that RBI dishes out is also tracking around 72 to 75, which is just a notch below where we've historically seen that the economy gets into a capex mode. So, well, which is a great sign. The government has pumped up its game on the capex side. The last budget was 7.5 lakh crores. The central government, if I include the state, it is 12.5 lakh crores. We saw roughly total 18 lakh crores of capex getting channelized into the economy. 6 of that was from the private side. So I'm keenly waiting for what kind of budget in the form of capex guidance the central government comes up with. So I would not be surprised if the number is north of 7.5, which was last year. So we are talking about the government of India, central government moving up the capex budget, the states moving up the budget. The private sector is clearly borrowing. It's visible in the credit growth. So we are walking in a zone which is about the manufacturing capex revival, and then the entire value chain. It includes power utilities, capital goods, consumables, construction, infra from the public infrastructure side. At some
Yeah.
point, hiring, mortgage. I mean, the value chain is long enough.
Okay, understood that as well. So we've spoken about a whole lot of sectors that you are bullish on. Anything that you're underweight on and you would advise investors to avoid in this year?
So I think on the equity side, real estate is a tricky one.
Hmm.
We because it's not because real estate will do good or bad. That's not what I'm trying to say. It's or the equity investor is the least in the pecking order of any rights when it comes to a real estate holding, and because there are a lot of legal structures that go into it. So we generally don't we avoid that heavily indebted or debt-laden businesses because the interest rates have been high. It is too early to say that they are softening down. We would also be a bit more, very choosy to modestly say about infra businesses. Infra is yet another debt-laden. Needless to say that infra will continue to grow, but it's more to do with, I think, it's a fertile ground for bond holders and various kind of debt lenders rather than equities in particular. We would indirectly play that. We would also, our investments are not to do with sectors, frankly, are more to do with stocks. Consumption names, straight consumption names, actually staples in particular look steeply priced. But then if rural picks up, the volume growth could sporadically look good in some cases. So we would be our preference or choice of investment will flow down from valuation risk reward more than anything else. Sectoral preferences can be there. It just helps us channelize our energy and effort. But then finally the investment is based on the valuation parameters and matrices.
Okay. We also saw something very interesting happening in the auto space, and the auto space has been buzzing, especially some of the counters like M&M have been showing some spectacular returns on the upside. I'll ask you about that, but first, the country's largest utility vehicle manufacturer, Mahindra and Mahindra, has been up in trade today. The company has also launched this all-new Thar 2WD in India at a starting price of 9.99 lakh rupees. Do you remember that this pricing is actually applicable on the first 10,000 units as well? Mrs. Singh, are you a Thar fan as well?
Well, till I sat into it, it looks great. I mean, and it's an amazing vehicle, no doubt about it. And
And what
it's
about the
amazing to
stock?
see what Indian automakers have come up with, be it Tatas, be it Mahindras. It's just awesome. And I'm one of those consumers who owns.
Okay, okay. So, and what, a consumer and an investor, I believe?
Oh yeah, so let's keep that things aside. It's a professional channel.
But for the investors, how do you really read the move that we've seen off late on M&M and some of the other stocks as well? Are you bullish on some of them more than the others?
I really like the auto ancillary space far more.
Okay.
The two-wheeler OEMs offer very good valuation comfort, but then there are growth issues. Let's see how it plays out. I think the rural volume uptick, if it happens, will have a different set of businesses which will do well. I think Mahindra in particular is reflecting that the market is kind of hinting that we could potentially see rural upticks, but that also includes agri implements. It also includes other kind of utility vehicles. The rural auto sales are of a different order.
Okay.
But then there are plenty of things. OEMs are one play, but auto ancillaries are also a great play. I mean, auto ancillary ecosystem in India is really world class, and it gives you access and exposure way beyond local domestic market. It gives you a global access as well.
Sure. Sure. Well noted that. Thank you so much, Mrs. Singh, for being with us on the show and speaking to us about these various pockets of the markets and how should investors be really approaching their portfolios as we move along in the new year as well, and where is the likely money going to be flowing to. All of those things, very, very interesting speaking to you. Here's hoping that the new year is absolutely fantastic for you, for your team, and for your family as well. Happy New Year to you. And so let's move on to see how the markets are also trading at this point in time before we wind down the show. About 60,767. That's the level at which you're looking at the Sensex trading at. 867 points up right now. 18,107 for the Nifty. Again, 1.4% uptick is what you're able to see. About 250 odd points of a jump is what you're able to see on the Nifty as well. We'll keep an eye out on the closing levels as well and help you understand all of those movements and the way experts are really looking at the market movement going forward from here too. So don't forget to stay tuned on to with us on Business Today TV and catch all the updates from the world of business and stock markets as well. Also stay engaged with us via other social media platforms, Facebook, Twitter, LinkedIn and Instagram. Many thanks for tuning in for now.